Hello and welcome to this new edition of ET Now Spotlight. I'm Anisha Jain and with me is the managing editor Nikunj Dalmia. Today we are putting the spotlight on the market itself because that's what is gaining the maximum momentum. It's not only climbed the wall of worries, but it's sitting at fresh 2023 highs, and a lot of sectors, whether FMCG, auto or the banking space, they are sitting at record high levels. Let's try and decode where the market is headed from here on. Nikunj, you told us in the month of May, don't sell and go away. Make hay in the month of May. What is it going to be in June? Don't prune your positions in June?
No, I guess, Anisha, just keep calm. You don't have to you don't have to preempt the next move. The ingredients which really triggered the market rally, or which engineered the comeback by the bull, I guess those factors are still intact. What were those factors? Adani Group chaos will get sorted out. Guess what? It has got sorted out. Foreign institutional investors will be back and they will be forced to buy the same stock they sold last year. They will be forced to buy them at higher levels, which is what I think they're doing on a daily basis. Third, earnings, more than earnings, the commentary which would be by the management would be focusing about vigor coming back in the consumption cycle, margin pressure speaking out, and inflationary pressure subsiding. I think if you do a word cloud of the earnings season this time, you pretty much will get the same combination which I just said. Peak of the margin pressure is behind them. Demand seems to be limping back into normalcy, and Indian consumer is shy, but they're confident that will make a comeback. Now, when you put all these factors together, you perhaps would be able to look at the market very differently, and which is what I guess markets, sensible investors have done. They've looked at what is next rather than what has gone back. In markets, you always focus on one simple thing, Anisha. I think our viewers, they should write it down, which is what I've learned in years of my market coverage experience. Markets always vote for rate of change. I'll say it again. Markets always vote for rate of change.
Okay.
In India's case, the rate of change has become from tentative to confident. Right? Same time last year, everybody was tentative about what would be the impact of inflation, what will happen to the credit cycle, and how demand will get punctured. All those concerns have got addressed. So India was never a bad story.
Right.
India was always an expensive story. So the tentativeness which came in the market, I guess that is getting addressed, and that explains why market, in a sense, have really surprised us on the upside.
So you're saying market factors the rate of change, but you also talked about the valuation of the Indian markets, right? The expectation was that we have seen the peak of earnings already, and it's probably going to see a slew of downgrades going forward as well. Do you think that thesis is out of the window now?
So why were the earnings downgrade coming in? The earnings downgrade were coming in. See, why do downgrades come out? Downgrades come out when earnings, they lack estimates, or when markets, even if they're growing, the P multiple cannot justify that that growth. So last year we saw a combination of both, which is markets were expensive, above the historical average, and the earnings promise was not that great. When we started the year, if you look at the best Nifty 50 target, and I think we did this consensus poll that everybody for FY20 calendar 23 had a flat assumption for the Nifty. So this year everybody was on the same side of the board that this would be a flat year of no return, and that's where the surprise came in. The surprise came in because going back to China has not been a great experience for foreign investors. Inflation has cooled off much faster than what everybody thought. Reserve Bank of India has moved ahead of what other central bankers have done, and in general, when flows have come back, they've come back with so much of gusto that you cannot ignore the brute force of liquidity. So in the short term, the sentiment has changed. In the medium term, the liquidity has changed. And in the long term, if I have to say, I think it's the earnings which is looking strong.
Very well put, but I wanted to discuss and deep dive into the banking space. Nifty Bank is sitting at record high levels, but the point was that it's been the consensus trade, right? It's not that it's suddenly discovered. On the other hand, there were talks of peaking credit cycle, etc. What's your own take? Should one, let's say, book profits and take something off when it comes to Bank Nifty, or do you expect this rally to continue?
If you're a genuine investor, and something which has been a great learning experience for me, I met a couple of folks who are part of the old boys club over the weekend, and the message I've come back with is that you should only sell if the valuations of the stock you own have got completely haywire, or you have something else which is looking more attractive. We must also remember and recognize that every business follows a cycle, and these cycles normally are 3 to 5 year cycle. Now for the banking sector per se, the real cycle actually, or the real credit cycle has started somewhere in 2021. So we are still in the nascent stage of the cycle. And when the cycle started, it also coincided with a very steep interest rate hike. So beginning of a cycle, when it coincides with the beginning of the rate cycle, it will obviously have an impact on the profitability. So profitability was strong. The desire to take credit was huge, and as a result, banks, they reported very strong growth both in terms of their NIMs, net interest margins, and also in terms of credit growth. So next 2 years will not be all that great. But that does not mean that the cycle is about to peak out. When will the cycle peak out? The cycle will peak out when bad loans, they start coming in, when in general the Indian economy goes through a rough patch, or the demand for credit goes away. I don't think none of the factors are at play. So if you're owning a stock right now, a good quality bank, you should own it. The difference is that within bank chains are there. Net turn is there. So look at SBI. When was the bank Nifty? The bank Nifty made a new high on 15th of December 2022. It's been about 6 months. Bank Nifty has gone back to same levels. But the lot has changed. Underlying fabric of the market, of the banking stocks. SBI is down. Kotak Mahindra Bank is right up there. IDFC Bank I think has hit a life high. And AU Financial is at a life high. But ICICI Bank is not leading the market carnage, and Axis Bank is underperforming. So the market is differentiating. 6 months ago, mid-tier PSU banks were the go-to space for a trader. That's not active. PSU banks like Bank of Baroda and SBI were in a sense the real three horsemen. The three horsemen of the market were SBI, BOB, and to some extent Canara Bank. That's not the case. So I guess the horsemen of this market rally now for the Bank Nifty would be different. The right to win, I think, is with the large banks. And you have to ask yourself a very simple data. How many folks we know in and around us are actually going to small banks to open accounts?
Hardly any, because you have the large banks doing everything.
Large bank they give you better service, better experience, better technology. When was the last time you went to a bank branch?
I don't even remember, not at least in the last 3-4 years, despite COVID.
Right. That means that branch network is no longer a novelty. If you would go from Pedder Road, and that's a lane in Bombay, that's a road in Bombay, from the beginning of the Pedder Road to the end of the Pedder Road, in 2018, there were 17 ATMs and there were 9 bank branches. Do you need that? You don't. So that consolidation, I think, is evident, and everything is becoming digital. So the right to win, I think, is with large banks. And I think that's why you should focus on, because these folks are getting CASA. These folks are getting, the large banks they have a technology and they're gaining market share. So if you want to be with banks, but you want to be with large banks. You want to be with PSU banks, but then you want to restrict yourself to top 2 or 3 names. What you don't want to do is that you don't want to buy the tail stocks. But tail stocks are like rising tide, because when the tide will reverse, they will reverse the fastest.
Timing those is really, really difficult. And as you pointed out, it's the texture of the market which is changing within the banking names. But just to wrap up the conversation, I wanted your sense regarding 3 big names which have actually not participated in the rally. We're talking about Nifty being just 200 points away from the life high level. But if you look at that heavyweight Reliance, HDFC Bank, as you talked about, and even IT names like Infosys, etc., they have not really participated in this rally. Do you think it can now be the case that these underdogs per se will now rise?
Anisha, that's 20% of the Nifty. Just 3 names that represent 20% of the Nifty. So it's like saying 1/5 of the market has not gone higher. It's not going to last for long. You cannot have a situation where ETF folks are coming and money is coming back into India. These 3 stocks, which individually have a different appeal, depending on the time frame you have, will underperform. My sense is HDFC Bank would be the first one off the block, because sooner than later, come July, the merger concerns would be over. And once those merger concerns are over, I guess, there are a lot of funds who would be forced to come back. See, it's all about a matter of judgment. Do you want to buy, like they say that, do you want to play seen or blind? There are a lot of global investors, they are ready to play seen rather than blind. The merger from a global investor standpoint is still blind. I'm speaking pure poker terminology. While I'm confident that I'm holding strong cards, but I'm still playing I'm still playing a blind game. That is the thing with HDFC Bank. I know that I have strong cards, but you want to see it and get 100% convinced. So a lot of that seen crowd will come back after the merger. Then you have Infosys. I think Infosys is trailing at 18 times trailing. With a 3 and 3.5% dividend yield. But that does not make it attractive, because for the tide to turn, you actually will have to see a genuine. See, for IT services to turn, you don't have to look at NASDAQ. That's a mistake a lot of folks are doing. Oh, NASDAQ is up, so Indian IT will go up. No. It's not what happened like that. The reason why NASDAQ is up is largely because of Alphabet, Amazon, Nvidia going higher. So different stocks.
Artificial intelligence.
Completely different stock. These folks have got nothing to do with artificial intelligence. If at all, artificial intelligence will be a problem for Indian IT companies.
IT, correct.
So they both cannot coexist. For Indian IT companies to genuinely come back, either the value has to become very cheap, which is where they're headed, which is they would head another quarter or so, maybe 2 quarters. But then if the tide changes, which is, oh, US banks, no problem. Fed says all is well. US elections, everything is smooth. Banking industry starts hiring. I think that's the tone. I don't think we are there yet. So the mistake, what a lot of traditionally the mistake what we've done is that we've looked at US tech and compared that with India, without realizing that the reason why US tech is back is because they're cannibalizing a lot of basic services. And whatever some of our good friends may deny, ultimately AI is something which is going to eat into the lunch.
Yeah, it's going to be a clear case disruptor as far as AI is concerned. But Nikunj, thank you so much for your time today. So that's the verdict coming in. Keep your calm in the month of June. Market tends to, give value to the rate of change, which seems to be positive for India at this point in time. If you have big quality names, the large cap banks, probably it's the best time to hold them and continue to drive the momentum. But the most important thing is what could be the joker in the pack? As we were talking about the card analogy, wait for the IT sector. Perhaps in a couple of quarters, we'll see the valuations bottoming as well. But thank you so much for joining us. We'll be back with more.
If you like this video, then like, share and subscribe to ET Now.